Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, August 25, 2017. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. All right, so it was a pretty back and forth week. All in all, we were up slightly, working off some of the short-term oversold condition that appeared last week. So the market still remains inside of this breakdown red candle, which is the peak or the top is at 246.60. That remains the most important number on this chart. Now I've taken away a lot of the other lines on the chart. I just tried to clear up the noise, clean up the mess a little bit, and basically we have one important area on the upside, which is the 246.60. If we close daily above that level, the market will want to make a push higher. Not to say they'll get above and close above the all-time highs. However, they'll want to make a push higher. That remains, on a daily chart closing basis, a very critical number. I still think it's not out of the question that they could make a run for that level, 246.60, give or take. They could pierce through it a little bit. They can come up short a little bit, but they can still make a run for that number. Next week is the week before the Labor Day holiday weekend. And therefore, as the week goes on, trading will get very, very light, or it has a tendency to get very, very light as people go on vacation, taking a long weekend. That's not to say the market can't be volatile next week. It certainly can be. We've certainly seen the pickup in volatility over the last few weeks. That's going to likely remain the case for the next couple of months. Keep in mind, we're still in what's called the dog days of summer, the summer doldrums. So trading remains light, and while the volume is extremely light, it's unlikely that we see a lot of downside pressure in the market. Of course, you can have down days. There's no question about it. However, once we get through Labor Day and, in through next week and into the weeks beyond that, that's when my expectation is the volume will pick up, and we're likely to see, unless we've seen all-time highs, we're likely to see more downside activity in the market. Now, I've got one more line down on the chart, and I've adjusted some numbers, and what I've done is I've put the line down at 227.50. That's where I think this market has ultimately, right? It's not going to all happen at one shot if we get the downside I'm expecting, but this is where I think the market has a chance to get to all the way down to 227.50 if we see the type of selling pressure that I think we're going to see over the next couple of months. It's not written in stone just yet, but if my work is correct, then I think we've only begun to see some downside momentum in the market. I think there's a lot more to come. Again, it's not going to happen all at once, and it's not going to be a straight line, and you're going to have big swings in both directions. That's not going to change. Let's go over to the weekly chart just to put the longer term in perspective, right? So what we have here is we had a couple of weeks down last week and the week before, and this week was slightly higher, and all we've done is come in to touch the 20-week moving average. So from a weekly chart perspective, this market is still in an uptrend. We have to realize that and make sure that we don't get short-sighted by the daily chart. As long as the weekly chart remains above the 20-week moving average, there's really no trouble in this market. Now, some of you might be asking, well, where did you even come up with the 227.50? I'm going to show you, and there's really three reasons why I come up with this number. The first reason is going back to the daily chart. We'll see here, and you can see it. Let me move this over. You can see here that there is a gap area. There's a gap that's left open on the chart down in this area. It's not exactly at 227.50. It's at 227.77. That's where the official gap is as far as my work is concerned. That's item number one. Let's go back to the weekly chart and we'll talk about item number two. You see this consolidation point here where the market consolidated for several weeks and then finally broke higher. Now that is an a consolidation point where markets will generally like to come back and test those areas. They like to check in at the breakout area. This is a breakout area from this consolidation phase, and it's also known as a scene of the crime. That's the second reason. The third reason is this area happens to be right in between the 25% and the 38.2% retracement from the pivot low that was put in down here in 2016, okay? And you really have two of them. And then you have the pivot high that was put in just recently. That gap fill that we saw on the daily chart and the scene of the crime, this breakout area that the market will most likely want to come back and check in at, those two things come right smack in the middle of the 2.5 and the 38.2% retracement. So I've rounded the number 227.50. The actual number is a couple of pennies short of that. But the point is that, you know, we don't have to get refined to the penny. And I'll refine the numbers if and when the market does start to trade lower. Again, there will be plenty of support areas in the mix in between where we are now and the 227.50. I'm just giving you a bird's eye view of what I'm looking at for the longer term picture. All right, let's go back to the daily chart and we'll head over to the IWM. Now, mind you that the spider was up about 0.25% today on not too bad volume. It was about the average 90-day volume, 63 million shares, not too bad. When you look over at the IWM had much lighter volume, however, was up about the same as the spider. Now, the IWM, we saw it up yesterday, we saw it up again today, and when the IWM is not down, for example, it's generally telling us that there's not a lot of near term, meaning in the short run, over the next day or two, there's not necessarily a lot of short-term trouble in the market on the downside. Of course, anything goes. However, when the IWM is up, we're still more likely in the camp of the market might want to float higher over the next day or two, and potentially even longer because we're going to have traditionally lighter volume as the week goes on next week. Now, the IWM is in an interesting position. We're into the 200 period moving average. We had the down move. We had this little tiny bearish wedge pattern being put in here. The question is the 200 going to reject the IWM, or is the IWM going to want to trade slightly higher, maybe to the 20 period moving average, maybe back up to the 138.74? Remember, that is an important number for the market. Well, it's hard to tell just looking at the IWM. It's hard to get a definitive picture of whether or not we're going to trade higher into the 20 or even into the 138.74 area. But one thing I do want to point out is when you go over on the transports, remember last night we discussed the 30 days down from the pivot top into essentially the 50-week moving average. So when we look at that, and we had that number in at 89.99, okay, and we came up on low yesterday of 9,010 and change. But we did come into touch and rebound off of the 50-period moving average. So that it stands to reason after that analysis with 30 days down, that's an important number, into the 50-week moving average, it stands to reason that the daily chart, while it was looking like we were going to break down, that was essentially, just from a daily chart perspective, a fake look at a breakdown. Got a little tongue-tied there. But when you look at the weekly chart, you can see pretty clearly why it stands to reason that we would have some kind of reaction off the 50-week moving average. So while these markets in total aren't necessarily in sync with each other, what we can do is we can say, well, if the transports are going to get a bounce off the 50-week moving average, is it going to be a one-day wonder, or should we trade a little bit higher and work off some of its oversold condition? And my intuition would tell me that we have slightly higher to trade at a minimum in the transports. It's not a guarantee, and my intuition isn't necessarily a technical tool. However, I think we can trade up to where the 20 period and the 200 period moving average are converging on the daily chart. That comes in at about 92.14, 92.15. That doesn't necessarily have to be a stopping point, but certainly should provide a level of overhead resistance for the transports. Tonight we'll take a look at the triple Qs or the NASDAQ market. And what's interesting here, and I really just wanted to do this because it's a nice little chart lesson. We've done this many, many times with this type of chart setup, but I wanted to point it out. You basically have, from a longer term perspective, this is bearish. Okay, this is trending lower, it's bearish, and it likely will go lower. However, you have a pattern inside of a pattern, and this is always conflicting information. And we've had this in many markets, and more recently than anything else, and that's one of the reasons why I want to point it out, because these are showing up on the charts more than normal. So what you have here is, you have this up candle from the other day, okay? That was a big up day. And what's happening now is we're consolidating, trapped in between the moving averages, but consolidating inside that candle. For example, yesterday we pierced through the low of that candle and we bounced back. Today we came up a couple of pennies short of that low and we finished close to the lows. Not at the low, but close to the lows. So we're trapped in between the 50 period and the 20 period moving average, but this little pattern here from the last few days tells me that the market still wants to push a little bit higher. But the bigger pattern is the breakdown candle from the 17th of August, and that will likely push the market lower. But as you know, and we've talked about this many, many times, the markets like to test the highs or close to the highs of the breakdown candles. So it's not out of the question, as far as I can see, that we might push a little bit higher into next week to test the top of the breakdown candle from the 17th of August. Doesn't have to happen, but it certainly can happen and isn't out of the realm of possibility. Like we did with the spiders, we'll look at the weekly chart of the triple Qs, and on the weekly chart, you can see here that while they broke down before the spider, again, like the IWM, like the transports, the Qs were a signal of trouble coming in the market long before the S&P 500 broke. But on the weekly chart, there's no trouble. And that's what we have to keep in mind. We don't want to get disjointed by the daily chart and the look of the daily chart. When you look at the weekly chart, still, this is nothing other than a pullback pattern above the moving averages, and this is essentially a bullish pattern. I'm not saying it's going higher. I think I'm right in the bigger picture, but when you look at this chart on the weekly basis, you have to just say to yourself, well, there's really nothing wrong with this market yet. There's no trouble. This is nothing other than a market that was just working off some of the overbought condition. It pulled back, and now we're just in a pullback pattern. The point I'm trying to get across is the market hasn't broken down yet despite what the daily chart looks like. I think it will, but we just have to take the big picture into consideration. Now we'll talk about the gold market a little bit. Gold had an interesting whipsaw day today. It did a little shimmy down to the 20 period moving average, which also coincided with a gap fill area. The actual gap took place, or the fill took place at 1282.90. The low today was 1281.30. So we came down, filled the gap, pierced through the 20 period moving average, and had a pretty nice rally off that area. We're still really in the same position that we discussed yesterday in the gold market. We have a tail candle as a pivot top in gold. However, we also are putting in a bullish pattern. Again, it's conflicting information, and the bullish pattern says that the market wants to push higher, but the tail candle says that it should trade lower under normal conditions. It's conflicting data, therefore, there's really no way to take a high probability trade in this market off this pattern because it's really telling us two different things. However, based on what I see on the chart, here's what I would say. And this is really just a chart lesson, and anybody that certainly wants to trade gold can take this information and do with it what they want. However, what I would say is that if we get above and close above on an hourly basis, above today's high that comes in at 1301 and change. Exactly is 1301 spot 40. If we got above hourly and started closing above that level hourly, then I would say gold is likely to challenge and potentially break through the highs that were put in from this tail candle on August 18th. Now, I don't think that's going to happen. So I think that the downside is actually going to play out in gold, and I think it's probably sooner than later. I still think that this tail candle is telling us that gold wants to trade lower. Again, it's not a high probability trade either way. This is just what I see on the chart. And if I was interested in taking a trade in the gold market, how I would treat it. I think that this bullish pattern that's being put in up here, I think this is gold's way of faking out the market, and I think we actually trade lower. Remember, it's the market's job, and it doesn't matter which market we're discussing, it's the market's job to make as many traders and investors look like fools as possible. And I think that's what's taking place here and now in the gold market. I think that it looks like it wants to trade higher. I think today's action gave a lot of traders the impression it wants to trade higher, and then I think the contrary happens. I think we trade lower. We'll see next week whether I'm right or wrong. Silver has even a more bullish look to it based on the daily chart, consolidating above, or pardon me, below the 200 period moving average. To me, it looks like it wants to trade higher, and that conflicts with everything I just discussed in gold. So therefore, really, there's no trade in gold. There's no trade in silver. There's too much conflicting data right in front of us on the chart. I just gave you what I think is going to take place in the gold market, and I certainly gave you how I would treat any closes on the upside hourly in the gold market. I think it will want to trade higher if we start getting above and closing hourly above today's high. But this chart here in silver is telling us that it wants to trade higher. Doesn't mean it has to, but that's what the pattern is telling us today. And when the pattern isn't clear on the daily chart, you go over to a larger time frame. Go over to the weekly chart. What does the weekly chart tell us? Well, we're trading above the 20-week moving average, below the 50, so we're trapped in there. We have a big up candle here, and we're starting to consolidate sideways, maybe inside this large green up candle. So what that's telling me is it would not be out of the question for silver to come down to test lower down on this green up candle. The bottom comes in, let me move this over. The bottom comes in at 1609.5. So call it 1610, the bottom of this green up candle. So that's a long way off in terms of the silver market from where we are now. So we can actually trade lower and still stay in somewhat of a bullish tone for the silver market. Again, not much help on the weekly chart. We can trade lower, we can trade higher. There's really no definitive pattern telling us which way silver wants to trade. We haven't looked at GDX in a while, so I think it's worth taking a look at. Remember the downsloping trend line that we looked at probably a few weeks ago now. Now look what happened. We pierced through it and was rejected. Then we finally consolidated and got above that trend line, and today we actually came down to retest that trend line, but we're closing yesterday and today above that trend line. Now what this is telling us is that the GDX has the ability to trade higher. If that's the case, that would tell us that it's likely to see gold trade higher. Again, more conflicting information. It doesn't necessarily clear things up, but the more information we have, the more evidence one way or the other we have, the better off we are. We take all the information, all the puzzle pieces, we put them on the table, and when the puzzle becomes clear, then it's clear sailing to take a trade because we have high probabilities. But when the puzzle's on the table in a bunch of pieces and we can't really put it together, or we don't have enough pieces to get the clear picture of what exactly the puzzle is, we just have to leave it alone. But as far as the GDX is saying, the GDX, as long as it stays above that trend line, my take is it'll want to trade higher. How much higher? That's the problem. There's really not a lot of room on the upside in the GDX because I think we're going to run into a lot of overhead resistance right here at this double top that comes in right around 23.80. That's only 40 cents from where we are, and we almost got there today. So there's going to be a lot of resistance there. If we can get through there, then we'll go, there's a gap fill up here, and then there's another double top area up here. So there are some levels on the upside that we can get to, but each and every level is going to provide an area of overhead resistance for the GDX market. One thing I do find interesting from a technical perspective, and I may or may not have mentioned this before, but you see this up green candle, okay, right here. This green up candle. We had a pullback pattern, and then we traded higher. What's interesting is, including the up candle, we pulled back to test the bottom portion of this green up candle for 10 days. And that's where we saw the breakout start to occur. We know from many, many discussions about numbers that 10 is an important number in the markets, and markets like to test the breakout areas. They like to test the bottom portion of large up candles, and they like to test the top portion of breakdown or large down candles. So we see it over and over and over again, and that's really the reason why I wanted to point that out one more time. It's easy to see it now. I'm pretty sure I didn't see it while it was occurring. Otherwise, I probably would have brought it to your attention. So I think I missed it while it was taking place. However, it's easy to see now, and the more you see them, the more you start to see them in real time, because you start looking for them. Crude oil, we're in the same position we were for the most part over the last several days. We're in the middle of a range. However, I'm becoming increasingly interested in the long side of crude oil. And not because we have a hurricane brewing in the Gulf of Mexico and anybody in the Texas area either batten down the hatches or get out, I guess. Those are not fun events. But let me show you why, and I brought this to your attention the last couple of days. We have a weekly pattern that's developing. This is a bullish pattern, and the longer it goes on, the more likely we're going to be to break to the upside. Now, the problem with this pattern is the bottom end of this big up candle, then we just had this discussion in the GDX market, the bottom portion happens to be at the low is 45.55. Now, we're a far cry away from 45.55. However, the longer we go sideways inside this big green up candle, the more likely we're going to be to break to the upside and achieve some of the upside objectives that I discussed yesterday, namely around the 50-period moving average, call it 51.5. So, we have another weekly close inside of this green up candle, and we've been trading in this sideways range for enough time where we could start to see a breakout at any point in time from this time or this point forward. So we'll watch it, but in terms of the weekly chart, in terms of the longer term picture over the next several weeks, I think we can work our way up to 51.5 in the crude market. Looking at the bond chart and the daily chart, we have exactly the same thing that we've had for the last several trading sessions in a row, if not longer. There's really nothing to discuss in the bond market other than the fact that we continue to ride the upsloping trend line day after day after day. Eventually, something has to break. It's either going to break to the upside or it's going to break down, and we'll see one hell of a fall in bonds if it does break down. But look where we are. As we continue to ride this trend line, we're pretty close to double top. I mean, double top is only up here. I'll draw it in. It's pretty interesting how this has happened. So here's double top, all right? And that's going to definitely provide a level of overhead resistance for the market. But as we continue to ride this trend line up, we're creeping up to double top. Quite fascinating, at least to me. Other than that, there's really nothing to add in the bond market. And we'll take a look at the dollar, where the dollar has broken down. And as far as I can tell, the dollar now has 88 cents on the dollar written all over it. It's just not a pattern that's going to tell us more upside is coming. We're breaking down. We've closed below an important level. And as far as I can tell, 88 cents on the dollar is coming. Whether it comes quickly or whether we melt down, I'm not 100% sure. But I think 88 cents on the dollar is in front of us. And at that point, the dollar will be another buy area. So I was long and wrong on the dollar. This is a market that I thought would trade higher sooner than later. It didn't happen. We're breaking down. I'm going to buy the dollar once again when we get to around 88 cents on the dollar. For now, just let it fall. That's where I think it's headed. And with that, I'm going to wrap it there tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.